Black swans and fat tails, they are the linguistic legacies of the financial crisis, all the rage back in 2008 and 2009, but somehow passé now when the financial market seems so remarkably calm. For savvy investors, though, now is the time to prepare for the next storm. Garth Friesen is co-chief investment officer at AVM and III, a $1.5 billion hedge fund in Boca Raton that specializes in fixed income, but also manages money specifically to protect against sudden and unexpected drops in asset prices. Yes, those black swans and fat tails. Garth is here with us right now. Garth, you have been kind enough to bring in some graphics, some charts that you use to help explain this stuff to your clients, and we're going to show it to everybody. I want to start off with volatility, because volatility, a somewhat jargony term, but let's look at this chart here. What is this telling us? These four separate charts: credit, equities, FX, and rates.
Well, what we do, Eric, is we track the volatility across all different asset classes. Typically, people focus on equities when they're thinking about general volatility in the market.
For example, right?
The VIX, right. But what we do is we look at all different markets: credit, equities, foreign exchange, rates, and commodities.
And that shows us that vol across asset classes, maybe except for commodities, is low right now.
Correct. These graphs show levels just before the credit crisis in 2008, and you can see that we're back down to levels where we were prior to the big disruption.
So what happens? Does this lull people into a false sense of security that everything's okay and it's going to be that way for a while?
Well, absolutely. Things are much better now than they were in 2008, and the other thing we track is realized volatility, and realized volatility has declined dramatically too, but the problem is that volatility doesn't necessarily stay at its lows for long periods of time.
That's a great segue into the next graphic, let's call it, that we have, because it shows us the characteristics of what you might call a black swan or a tail event. Why don't you walk us through a couple of these quickly?
Sure. What we see when we go back and look at tail events historically is we see certain patterns of behavior in the market. And what we see is that there's typically 5 or 6 things that take place repeatedly, such as...
In addition to equity markets falling out of bed.
Right. The obvious is that equity markets fall. But other things happen, such as interest rates fall, short-term interest rates fall, yield curves tend to steepen, credit spreads widen, implied volatilities increase across all asset classes, and correlations increase as well. Absolutely.
So you see all kinds of crazy things happening at the same time. The other thing that people don't realize, we've talked about it a bit, and it's been discussed during the credit crisis and the financial crisis that followed, is just how frequent these events are. They happen more often than we think, don't they?
Right, absolutely. When you look back historically, we've seen a number of different tail events, and one thing that people can do is look statistically how often these events are supposed to happen. In fact, they happen much more or more often.
And we're showing that with these red lines, right? These are multi-standard deviation moves, and what that really tells us is that what? That this is unexpected, unpredictable?
Yes, statisticians will tell you that these type of events should have only happened 3 times, for example, in the last 10 years, when in fact they've happened 10 or 11 times.
Let's talk about what you do, okay? You've got choices to make as a money manager. How do you, if you want to protect yourself against, effectively buy insurance against these drops in asset prices and the movements that are associated with them, what do you do?
Well, there isn't one answer for that, Eric. What you really have to do is it depends on the environment that you're in. In low volatility environments like we're in right now, we think the best option is to actually purchase insurance, which is your typical hedging strategy, such as buying put options on equities. But more importantly, from a value perspective, to look at other asset classes, to look at options on interest rates, look at options on credit spreads, look at options on commodities and foreign exchange as other alternatives.
Okay, so what if it's not a benign environment or a seemingly benign environment like the one we're in right now? What if we're getting closer to what feels like a crisis? Those options become very expensive.
Right. They actually become impractical to buy. Just to give you an example, in 2008, post-Lehman, if you were to try to hedge your portfolio with traditional put options on equities, in order to get 5 times your money, which is a number that a lot of people are looking for when they're investing in these types of programs, you'd have had to have the S&P fall below 0. In other words, it wasn't possible to get 5 times your money.
Statistically impossible, right?
Comparing that to today, you'd need a drop of something like in the low 30% to get a 5 times payout.
Let's bring up this one last graphic. I like to call it the gears because you're going to help us explain the mechanics, I guess the thinking behind black swan hedging.
Right. Well, what we do
is...
is...
So there are those gears in the middle there.
Right. What we have to do in trying to limit the cost of insurance, because insurance is something that not everybody wants to pay for in the protection of their portfolio. But what we do is we look across all those different asset classes, again, foreign exchange, credit, equity, et cetera, and try to find the cheapest options available in the market to express a specific view. An example is a client may have a view that global inflation is a large concern for them. And what we'll do is look at all the different markets globally as well as just in the U.S. to try to find the best way to express that. And that may not be in interest rates, which is the typical place where people would express that view. It may be better, for example, to look into the commodities market.
So you need to broaden your thinking in terms of assets and also in terms of geographies.
Right, and be prepared to switch your hedges when the macro environment changes.
All right, Garth, great of you to join us here. Garth Friesen, Co-Chief Investment Officer at AVM and III. It's a $1.5 billion hedge fund down in Boca Raton. Does a lot of this black swan risk hedging.